So something really important happened this week that I want you to know about, which is that the Big Daddy Federal Reserve Bank ran a stress test on 23 of the major commercial banks.
The Fed tested how 23 banks would fare in an economic downturn. Each of those banks has more than $100 billion in assets.
Each of the 23 major banks they tested had at least $100 billion worth of assets. So they're testing some of the world's largest banks that you're probably banking at right now. Normally, the Fed does this test either once a year or once every other year, depending on the size of the bank. And when they do this, normally people don't pay attention. But because of the collapse of the smaller regional banks earlier this year, everyone's paying really close attention to what's called minimum capital requirements, which is just a fancy way of saying, do the banks have enough money if something bad were to happen? And the good news is, all 23 banks passed when they ran it through a simulation where the banks lost a hypothetical $541 billion.
The Fed determined they all had enough capital on hand to survive a recession or market shock.
But that still leaves a lot of questions, like, is $540 billion a lot of money? Yes, objectively it is, but compared to what? And also, have these bank stress tests been effective in predicting a major bank failure in the past? Because if they haven't, what's the point of doing them to begin with? And how come we didn't catch the smaller banks from collapsing earlier this year? And that's why not everyone believes that things are going to be fine in a recession, and some people are still understandably skeptical about our banking system. So today I want to share with you what I found out from the Fed's latest release on this stress test that happened this week and explain how everything works, because I also want to feel safe about keeping my money in the bank. So let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the really short video. By the way, you don't need to know or memorize any of the stuff inside this video because it's gonna get complicated. But I still wanted to make this video for the 5 nerds that might be watching this video in case you want to understand how the banking system works and if your bank is safe in a recession. So let's get started, but first, let's recap how we got here. Thanks to rising prices, aka inflation, the Fed has been making money more expensive to borrow by raising interest rates. But before that happened, a bunch of the smaller banks put our money into treasury bonds. Now that's also how banks make money. They lend money and they invest our money into safe assets like treasury bonds to collect an interest. But there was a problem. When the Fed started to increase interest rates to fight inflation, it negatively affected those bond values, and so the value of our deposits also went down. And that made people panic. They all wanted their money out of the bank at the same time, and that made those banks sell their assets at a loss, making some of them insolvent. That's a fancy way of saying out of money, and now you're all caught up. Now, because of that though, the Fed wants to make sure that the banks don't make that same mistake, and so they make them take the stress test just to see how much the system can actually take. And they divide this test based on how big these banks are. Type 1, Type 2, Type 3, Type 4. Now, 1, 2, and 3 are banks that are big enough that they need to take the test every single year. And then Type 4 needs to take the test every other year, but sometimes they'll volunteer. This week was the big annual test, and here were some of the banks that took it. Banks like Bank of America, Barclays, Capital One, JP Morgan, Wells Fargo, and those are just some of the names you've probably heard of. Now, all of these banks need to have these capital requirements, but instead of calling it something easy that everyone can understand, they have their own fancy terminology for it, and they call it CET1, or Common Equity Tier 1. This is like a bank's piggy bank or savings account to cover them against any losses, and the piggy bank is funded by the bank's shareholders. Now it's the Fed, the central bank, aka the daddy bank, that tells all the other kid banks how much money they need to have inside of their piggy bank, which is based on their size. And then they grade those banks based on how well they do after they run those stress tests. And there's 5 different scores. There's well capitalized, adequately capitalized, undercapitalized, significantly undercapitalized, and critically undercapitalized. It's exactly like grade school. A, B, C, D, or F. You want to aim for the A, you don't want to get the F, and if you pass with just a D, you will probably get grounded. And it's the same way in the banking system. If those banks pass with a low grade, the Papa Bank will punish them with how much money they can lend and put restrictions on how much money they can pay their shareholders in the form of dividends. Now, to get the A in this case, in other words, to be considered well capitalized after this stress test, a bank that's considered systematically too big to fail needs to have left at least 10% of total assets inside of this piggy bank. So for the 23 banks that just got tested, which had at least $100 billion worth of assets, they need to have left at least $10 billion in that piggy bank to get the A and be considered well capitalized. So that's the parameter of this test, and that's what they're looking for. And here's the results of that simulation. The size of their piggy bank went from 12.4% that it's roughly at right now down to 10.1%. And that's actually really good, surprisingly, because remember, all of them don't need to pass with 10% because that's the best grade you can get. A passing grade in this case, a D, or the minimum to be compliant, is actually 4.5%. So what this test showed is that the banks could lose $540 billion worth and still continue to be operational and still give out loans to people. That's the good news, but there's a huge catch. The catch is that that grade, which is an A, represents the average across the industry. And that's almost like coming inside a classroom, a physics AP, and being like, well, this classroom is A+. It might be. But some students are A students and some students might be C students. It depends, right? Even though the average might be high, not everyone is equal. So later in the video, I'll show you which of these banks got the A and which ones passed with a C. Thankfully, none of them passed with a D, but there were some C student banks. That's one thing I didn't see the media talk about, which I think is really important. But ultimately, the real question is this: how much is $540 billion? To me, an average person, $100 billion worth of losses would sound like a lot. But what does that actually mean? The Fed defines this as a severely adverse scenario. But specifically, what would need to happen to the world for the banks to lose $540 billion? How did the Fed come up with this number? Luckily, later in that document, they actually define the specifics of what would have to happen. This scenario is characterized by a severe global recession with prolonged declines in both residential and commercial real estate prices, which spill over into the corporate sector and affect investment sentiment. Sounds really complicated and very vague, but here's the specific numbers of their worst case scenario. They assume that unemployment rate would spike to 10%. Right now, it's only at 3.7, so almost 3 times worse. They assume an 8.75% decline to the GDP, and they assume the stock market would fall by 45%. They also assume the VIX would reach 75. Remember, the VIX just measures how scared people are. It measures volatility, and right now, people aren't really scared because the VIX reads 13.5. But at the height of the pandemic, it reached 66, and they're assuming it could go up as high as 75, so even worse than the pandemic. And they also assume that real estate could lose 38 to 40% from 2022 to 2024. So based on all of that, I think this is a very fair worst case scenario. Sure, things could always get even worse, but this is already really bad, and hopefully this never happens. But if it does, I promised you the best banks and the weakest banks, and here's what they are based on this simulation. Citizens Bank came out to be the weakest at 6.4% in their piggy bank, and the strongest bank with the least risk was Charles Schwab at 22.8%. Now, I do think it's a good idea to go back and just pause the list and check everything yourself, but if this were to happen, the majority of the $540 billion worth of losses would come from loans, followed by credit cards, and then commercial real estate. So that's the breakdown, but the ultimate question is, how reliable is all of this really? Just because we created a lot of complicated ways to measure how safe a bank might be, doesn't mean that it actually is. And that's because a bank is only as safe as the variables we plug into our equations. And those variables are mostly based on what we know so far. It's the reason why hacking a computer is sometimes a lot easier than you think. You might feel safe, but that attack vector could be coming from a place you didn't even consider that it could. And it's exactly why, even though we have all of these stress tests in place, the smaller regional banks still failed. Even though there were actually warning signs and we knew that some of these banks were weak, they still flew under the radar because they were too small. So it's not enough to just know which banks are toxic, you also have to make them be compliant to take the test in the first place, and that was the big mistake. The good news though is at least for now, our money should be considered relatively safe, at least with the bigger commercial banks. So I hope this short video made your money feel a little safer. This was a really hard video to put together just because of how complicated all this stuff was to understand, but I hope it made a little sense. As always, I hope you have a wonderful rest of your day. Focus on your own investment journey. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. Links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. See you soon. Bye-bye.